Welcome back to another Macro Monday. This week, I am here to tell you that despite what Treasury Secretary Scott Bessent says, the K-shaped economy is not over. If you want to learn more about what the K-shaped economy actually is, I'm not going to get fully into it in this video. I made a video a few months ago that completely describes it. So if you do want to learn more about what it is, there's a little bit on this slide, but I have a whole video for it. I'm going to have it pop up as I'm talking right now. So this is actually a slide to get us started directly from that previous video. I have not updated it at all. And this is one of the points I made to show some of the characteristics of our K-shaped economy. So what does this chart say? In the blue line, you have the wage growth of the bottom 25% of earners. In the red line, you have the wage growth of the top 25% of earners. And what we saw is that while both were slowing over the last few years when I made this video, the wage growth of the top 25% of earners was slowing much slower than the wage growth of the bottom 25% of earners. You can see the blue line in the clip falls much more dramatically than the red line. Now, since then, this has become a major point of discussion for the people that say the K-shaped economy is over. And I'm going to show you what they mean when I update this. So in the next slide, it's going to be these exact charts, but they're going to be updated to today. And what you can see is the divergence between the two has changed. So what has happened? The wage growth of the top 25% of earners has slowed alongside to almost come back in par with the wage growth of the bottom 25% of earners. So you might say, okay, wage growth is now back at par, K-shaped economy over. That is some of the arguments that are being made right now. But what I think these arguments miss is that the K-shaped economy is not just a point-in-time data series where if things start to look a little bit better relatively for the bottom decile or half or 80%, 90% of earners or wealth havers, that doesn't mean that the dynamics that have built up over the course of decades no longer exist. And I'm going to show some of those for the duration of this video. But before I continue, I have been told by our social teams that a decent amount of people who watch our videos are not subscribed to our channel. So if you are one of those people, if you could just take a quick second to hit that subscribe button before I continue, that would be greatly appreciated. Okay, now that that's out of the way, here's what I mean by the structural situation that has existed in the US economy going back decades. And now I want to be clear here. The chart on the left, they are not the same axes on each side. So at quick glance, you might look at this chart and say, oh, wow, the top 1% has way more wealth than the bottom 99%. That is not true. As you can see, the axis that the blue line is on goes from 22% to 32%. The axis that the red line is on goes from 68% to 80%. So I don't want to mislead you here. My goal for this chart is to show you how things have trended over the last few decades. And as you can see, the top 1% in blue has gained a much higher percent of total US wealth compared to the bottom 99% in red. So the dynamics or the feelings around this issue are not that the 1% has more than the bottom 99% in aggregate. It's A, they have more than what some people would consider their fair share. And then two, it has more to do with the trend. So the richest people, the top 1%, are getting richer, while everyone else in the middle and the bottom is getting poorer relatively to the entire US economy. And as you can see from the clip here, where I zoom in on the last few years, you can see that K-shape. So again, this is not a point in time issue where you get some spending data or some wage data that says, oh, maybe things aren't not so bad right now for the bottom 99% or the bottom 90%, whatever you want to use. That is not what I mean, at least when I talk about the K-shaped economy. I'm sure there are plenty of periods of time throughout this chart here where things looked okay for everyone else. It more has to do with the long-term structural setup of what we've seen over the last few decades. And what helps to explain that? Well, is that asset owners have benefited heavily since the global financial crisis. And now another disclaimer, I 100% cherry picked the starting point for the Nasdaq and the S&P 500, but I will say it does cover almost 2 decades. So this goes back to the global financial crisis, the S&P and the Nasdaq charts that are on the outside of the bar chart in the middle. And stocks effectively, outside of a period during COVID, have gone straight up. There have been some minor putbacks, but we really haven't seen a huge retracement in the equity indices, the major ones that most people in the US use, in a very, very, very long time. And the people who have benefited from that are the people who obviously own corporate equities. Who owns corporate equities? It's probably not that surprising to hear that it's mostly people in the top 1%, the top 0.1%. In terms of the 0.1%, over 50% of their assets are in corporate equities. And then in the top 1%, that number is a little under 50%. And then if you look here at the bottom 50%, you can see that's under 10%. I believe it was 6 or 7% when I built this chart. So what we see here is it doesn't really have to do with spending data. It doesn't really have to do with wage growth. A lot of it has to do with the assets that are being held and who is holding those assets. And so that's how you get a chart like this. Historically, there was a tight relationship between consumer confidence and S&P 500 forward earnings. You can see that here from the chart on the left. When consumers were feeling more confident, they would spend more money, and that would lead to better earnings for S&P 500 companies. That has broken down a bit. At least in this year, the relationship has clearly gotten more shaky if you look towards the end of the big chart. I zoom in here on the clip chart to show you since the beginning of the year, a little bit after the beginning of the year. And you can see these lines are trending in two completely different directions. S&P earnings have been crushing expectations. Quarter after quarter, they have just gone higher. On the flip side, consumer confidence has continued to fall. So there is a disconnect here between how consumers are feeling and the performance of companies. So what are some of the risks of this? So why does this matter? Why are we even talking about this? So the big question that has persisted, that has not come to fruition since this conversation has started, the spending data looks fantastic. But the question is, what if people do stop spending? What if some point this fall in consumer confidence leads to behavior, which is typically the case? Well, there's a risk here, and the risk exists because of who does the spending. Now, the top 10% of income share, they spend about 20% of total outlays. So they're doing almost double their share of income. However, still, if you look at the bottom 90%, they're not spending 90% of total outlays, but it is 80% of total outlays. So the vast majority of people, 90% of people, are spending 80% of the total outlays. So if the vast majority of people aren't feeling really good about what's going on, and eventually that does hit spending patterns, that's a risk. And overall, it just questions the sustainability of our current economic setup. How much longer can this last? So, for example, a dynamic we have seen recently is that inflation has outpaced wage gains. For the last 4 months, real wage growth has turned negative. So inflation has been growing faster than wages. People are losing real dollars. So again, what we have seen since inflation has been sticky, we've had a period where private wage growth was still above that sticky 3 to 4% inflation. Wage growth was growing. As I showed you earlier, wage growth has now been slowing for some time now, and due partly to the spike in energy that we've seen, headline inflation is now above wages. So this begs the question, how much longer can this last? How long can the consumer, the US consumer, stay as resilient as it has been? This is not me saying that this is happening imminently. Not at all. Never bet against the US consumer. I've been told that a bunch of times, and I believe that. The US consumer is a special, special, special beast. But what I am saying is don't stop talking about the K-shaped economy. It is very important and could have real implications down the line. And this is not to mention the potential political implications that we have seen over the last decade plus about who on each side of the aisle is winning primaries and being put into office. But we don't talk about politics here. I do that on my other newsletter, Bipartisan. Check it out on LinkedIn if you're interested. But how could this impact the market? Well, we've touched on this a little bit, but you're probably not that surprised to hear that if consumer spending is related to S&P 500 earnings, well, so too is retail sales. There's a very tight relationship. In fact, consumption is the main driver of earnings growth. Again, not super surprising since consumption is nearly 70% of US GDP. If we see a slowdown in retail sales, and as you can see from this chart on the left, it has continued to go up year over year. Never bet against the US consumer. But if we were to see a slowdown in retail sales, what we would expect to happen is then a slowdown in the S&P 500 forward earnings. And the S&P 500 forward earnings is the main driver of equity returns. Again, not surprising. So that's where the risk lies. If people are feeling bad about the economy, and that translates to decreased spending, that translates to decreased earnings for S&P 500 companies, which translates to a lower S&P 500. So again, I want to be clear. This is not me saying that something is imminently about to break. In fact, things look relatively healthy. There are some cracks showing, but there have been cracks showing for a really long time. The spending data is good, despite how people feel about the economy. The point that I wanted to make this week in this Macro Monday is that doesn't mean we should stop talking about it. This is something that's been going on for decades. Discontent has been rising. And yes, nothing has broken yet, but that does not necessarily mean that nothing will break in the future. I hope you enjoyed this video. I hope you learned something new. If you did, it would be awesome if you took a second to like the video, subscribe to our channel. I will see you next week for another Macro Monday.